Welcome to Taking Stock for the week ending the 11th of March 2022. Where joining me today is our Senior Equities Analyst, Jason Yin, to stream to you all things share market. Welcome, Jason, and appreciate your time.
Thanks for having me, Kien.
We also hope everyone is safe and well, not only from COVID, but also the floods in the eastern parts of Australia. And our thoughts also go out to those with relatives and friends that are affected by the Ukraine-Russian conflict. Now on to the markets. Even though the reporting season is over, our team of analysts are now scouring the market for opportunities, looking for those with strong numbers in the face of the market volatility. But before we present on some of these opportunities, let's talk about a key concern that some of our investors are having right now. The oil price has spiked even further this week after the US and UK announced a ban on Russian oil, while Europe plans to reduce its gas imports by 2/3 this year. This is significant because Russia accounts for 11% of global oil production. Meanwhile, demand for oil is still strong as the global economy recovers from mobility restrictions due to COVID.
Yeah, the concerning thing here, Kien, is that high oil prices will compound the inflationary pressures brought on by COVID and central bank stimulus. It's often said that oil is the lubricant of the global economy, so high energy prices tend to lift the cost of goods and services, which could eventually lead to lower consumer demand and a reduction in corporate profits.
That's right, Jason. And our research team has conducted some analysis on the price of oil. By charting the All Odds Index against the oil price going back to the 1970s, we make the following observations. Oil price rises, as long as they are steady, have limited impact on the share market, as suggested by a positive correlation of 0.77. However, it's the oil price shocks, that is, when the oil price escalates in such a short space of time, it tends to coincide with periods of negative share price returns. For example, during the 1973 Arab oil embargo or 1980 Iran-Iraq war. Also the 1990 Persian Gulf War, the GFC in 2007, and the Middle East instability in 2011.
Yeah, this is a very interesting observation. We can see that any time when oil price shocks have historically coincided with periods of global economic recession, it is also important to point out that correlation is not exactly causation. What this means is that oil may not be the driver of these recessions. For example, if we look at the chart and back at the GFC, this was driven by excess debt and housing market downturn. So it is important to understand that oil price shocks on its own does not necessarily mean that market returns will be poor for the year ahead.
Yes, Jason. While the probability of a recession has heightened, this risk remains low for now. Take, for instance, US yields. An inverted yield curve has historically been a solid indicator of a market downturn and occurs when short-term yields are higher than long-term yields. The difference between these yields are shown on screen. As you can see, when the line moves below zero, a recession tends to eventuate a few months later. Now, the spread is currently around 1.5%, still well above levels that would cause concern. And this can also be translated into the following chart, which shows the probability of a US recession, currently at around 6%. But we will be continuing to monitor this situation in coming months.
Yeah, it's also important when looking at historical data that history doesn't always repeat itself in exactly the same way. There are positive factors in today's environment that may stem the onset of oil price shocks. Some of these factors include our lower dependency on oil. Many industries have become less reliant on oil as an energy source. For example, if we look at the amount of oil that's generated, the same level of GDP in the US today, it is 65% less than what it was in the 1970s and 20% less than what it was during the GFC. Another factor is that there are automatic stabilizers in the Australian economy. As a country, we have a unique situation in that despite our status as a net importer of oil, we're also a net exporter of energy. What this means is our economy benefits from strong commodity prices, such as those from iron ore, gas, coal, and copper. The national GDP generated from our large resource companies such as BHP and Rio Tinto can partially offset some of the weaknesses arising from other parts of our economy. Higher savings rates. Australian consumers have built up $250 billion in excess savings throughout the pandemic. Also, many companies are in a strong financial health position following the number of equity raises that we have seen since the start of COVID. So, all these characteristics help cushion oil price shocks.
Yes, Jason, don't forget interest rates as well. They remain quite low.
Mm.
Sure, the RBA has alluded to rate rises this year, but in absolute terms, they remain the lowest in history, and central banks are also cognizant not to tighten too strongly as well. Let's turn our attention to some opportunities presented during the week. With increasing geopolitical risk, it's also timely for us to look at some gold exposures. And this week, we initiated coverage on Northern Star Resources as a borderline star growth stock. The miner is the sixth largest gold producer and has a portfolio of high-grade gold deposits with quite low production costs in Western Australia and Alaska. Previously, we removed the stock from coverage due to its merger with Saracen Minerals, which led to a significant dilution in its return on invested capital.
Astute investors may be questioning the large disparity between the earnings growth and revenue growth for this year. The reason for this is due to increased operating costs from COVID and much higher depreciation charges on its existing assets. We believe this is a transitory issue and earnings growth should normalize in FY23. Meanwhile, despite the negative earnings revisions, we expect the trend to revert on the back of stronger gold prices.
And speaking about these opportunities, Jace, we have reinitiated coverage on Weisstech as a borderline star growth stock. Just to remind investors, Weisstech, they provide cloud-based software to help freight companies manage their supply deliveries. In February 2020, we had to remove the company from our star portfolio due to heightened active risks, including contingent liabilities from their numerous acquisitions, which led to a dilution in their return on equity. There was also a lack of operational transparency, which led to the release of a short report followed by an earnings downgrade as well.
Yeah, in second half 21, we noticed a recovery in the company's profitability ratios with return on equity increasing to around 13% and net profit margins rising to around 26. Moreover, solid growth in cash flows has led to a strong earnings quality. Positively, the company has upgraded its earnings guidance, and this has translated to earnings revisions of 7%. Earnings growth is now expected to be close to 50% for the year ahead. Meanwhile, the founder, Richard White, continues to hold a significant stake in the business at 38%. Now, looking at our corporate calendar, things are looking pretty quiet with no companies reporting and no ex-dividend dates from any of our star income stocks.
Yes, Jace, but for trend-sensitive investors, Stock Doctor has the SD Max and also the SD30 TSR. For those who are highly trend-sensitive, utilizing the SD Max, the SD Moving Average crossover, we note that Perseus Mining, PWR Holdings, Smart Group, and Alkane Resources have triggered bullish signals, while AUB Group, Credit Corp, MA Financial, and Telstra turned bearish on the SD Max. And with regards to the SD30 TSR, that's the 30% stop loss or gain from its highs or lows. Both Aristocrat and Baby Bunting triggered an exit. In Under the Microscope this week, we reintroduce a company that many clients may be familiar with. It's called IDP Education. Jason, I remember you flagged several active risks during COVID, and still the share price has been relatively resilient, even though many Australian universities were under a bit of cash flow strain from the significant decline in student enrolments. Have these risks subsided?
That's a great question, Kien. For members who are not really familiar with the operations of IEL, the company is first and foremost a co-owner of something that's called the International English Language Testing System, otherwise known as IELTS. This system is one of the world's leading high-stakes English language tests and is often a prerequisite for many students wishing to study abroad. The company also generates revenue by placing students into education courses such as with Australian and international universities. The risks that we flagged in late 2020 appears to have diminished as there is a loosening of border and travel restrictions, which should see a normalization of IEL student placement business, as well as an improvement in the IELTS testing volumes. Meanwhile, both ROE, net profit margins have recovered to 14 and 9% respectively over the last half, and this follows the acquisition of IELTS testing arm from the British Council.
Thanks, Jace. I noticed that its share price has declined due to recent volatility in Europe, creating uncertainty about students wanting to study abroad. But this share price weakness could represent opportunity for those who believe in the earnings recovery as international borders open. Trend-sensitive investors, however, should still remain on the sidelines until more positive momentum comes back to the share price. We also notice a slight lift in the level of short interest, and the shorts are driven by the stock's high valuation multiple, with the forecast PE trading at 80 times. Although this seems expensive, we believe the multiple should come down once 2 periods of strong earnings growth flows through. Positively, though, the absolute amount of short interest remains quite low at around 5%.
Yeah, speaking about active risks, the company's CEO, Andrew Barkla, sold down around 63% of his holdings over the last 12 months. Significant sell downs by company executives may be yellow flag, but we believe in this situation it was due to personal reasons. In the case of IEL, we feel the potential sell down by the company's largest shareholder, which is Education Australia, who holds 25% of total shares, may have a sway on investor sentiment, although we understand that universities are currently strapped for cash due to the collapse of overseas student numbers, so we will continue to report and monitor changes of this active risk going forward.
With the reporting season now over, our analysts are busy looking for opportunities on the back of the numbers. And with the ongoing share market volatility and elevated oil prices, an important question this week is, how do I construct a portfolio from our star stock universe now? You would have noticed that there have been some star stock transitions between star growth stock and borderline star growth stock during the week as our star growth stock ranking model is implemented. But this shouldn't impact your star stock holdings because the fundamentals for these companies have not really changed. Both star growth stocks and borderline star growth stocks are fundamentally strong businesses because they need to pass our stringent quantitative screening process.
From a portfolio management perspective over the last reporting season, we have reduced our holding in the number of consumer discretionary stocks. These include Nick Scali, Accent Group, and City Chic. Now, this was not due to our anticipation of higher oil prices or interest rates, but rather because the numbers told us that many of these companies will find it more difficult to generate stronger profits this year. In the meantime, our portfolio is evolving towards commodity-based companies because their earnings are recovering. So for example, we've included Woodside Petroleum, Northern Star Resources, and a few others into our coverage. So it makes sense for investors to look at some of these opportunities within your own portfolios. Those who want to take advantage of the inflation thematic can refer to our Taking Stock video that we did on the 29th of October last year.
Yes, Jace, the portfolio strategy around the inflation thematic was answered in Question of the Week. Note that our star stock process is predominantly based on a quantitative thresholds. As a result, you may want to apply your own qualitative assessment on your stocks. We have a selection of over 50 growth stocks and close to 40 star income stocks, so you can invest in the stocks you are comfortable with based on your investment objective, risk profile, and stage of life. And due to our large client following, we need to recommend more stocks than the average portfolio of 15 to 20 stocks because we are mindful of liquidity issues when our clients are buying and selling a stock at once. Just make sure you don't just hold on to a few stocks due to concentration risk.
If you're a trend-sensitive investor, a useful way to select stocks is by referring to the Star Growth and Star Income watch lists, and then sorting that list by SD-Max and SD30 TSR so you can see and invest in the stocks that are uptrending. Otherwise, if you want to replicate Lincoln's Star Growth and Star Income stocks, then you can simply hold all of these stocks in your portfolio. You can also use the portfolio constructor to calculate how many stocks you need to buy and then set up your alerts to ensure that you are up to date with all of our star stock changes. Although there are many stocks in our portfolio, the portfolio optimizer and reporting tools are a great way to make this task a breeze.
Yes, Jay, Stock Doctor has some great tools to help you manage your portfolio. But that's all we have time for today. Thanks again for your contributions.
Thanks for having me, Kien.
Also, we've launched our annual customer survey this week via email, and we encourage our members to take part in the survey. Your feedback is valuable because it will help us understand your needs better so we can constantly improve and innovate. Now, to summarize our session, oil price shocks are not necessarily bad for the share markets. Embrace the volatility and look for opportunities in companies which have been sold down irrespective of their fundamentals, such as those stocks coming into our universe like Wisetech, IDP Education, or Northern Star. Take care and have a happy, healthy, and prosperous week, everyone.